Markets to Watch, sponsored by Pagetrader.com, starts now.
Welcome back to CEO Money. All right, David Williams, Pagetrader.com, on the show with us today. All right, David, what's going on?
Thanks for having me on, Michael. We're watching the S&P today and the Dow break out to all-time new highs. For our clients who trade the markets somewhat shorter term, we had forecast that if the market gets above 28.06, it would advance today to 28.13 to 28.14. Today, we just made a high at 28.1250. This is a great example of the kind of work that we do where we can confidently say in advance that a very specific thing, a very specific price is going to be hit on that day, allowing traders and investors to take advantage of those forecasts and trade right to those numbers.
Did you guys, so am I taking it you guys got long at 28.06?
Well, we were looking for a confirmed breakout above 28.06, so slightly higher than that, but roughly 28.07.5, 28.08 up to 28.12.5 so far, just under 5 points of advance in a very slow and quiet day. Today was sideways for many, many hours, but all of our clients knew the information 3.5, 4 hours ago, exactly what to do in today's session. So our specialty, of course, is forecasting, and one of the main things that we're following now, aside from the stock market, Michael, is we're watching Bitcoin, and we're beginning to forecast in that market as well. We do think that right now, while we don't have a position in Bitcoin, we think that Bitcoin is going to be retesting the $12,000 level on Thursday of next week, plus or minus a day. That's January 25th, plus or minus a day. Since we don't have a position right now, we'll turn that into a trade for our clients, of course, later, probably on Monday or Tuesday of next week. And if anybody comes to our website, I'd like them to read our trading disclaimer. Trading is risky. You can lose money, and so on. It's all at the bottom of every page of our website.
Got it. David, trading's never been risky, right?
Yeah.
It's always been risky, and forecasting the market is a different skill than trading the market. But our clientele have learned to take these forecasts, because that's our specialty, and then put them to work in actually trading the market.
David, do you think the market today likes the fact the government may potentially shut down, and maybe we can kind of stop some of the insanity up there? Because it seems to be reacting pretty well to that for the most part.
It does. I'm not good with the fundamentals. I can't make the decision that it's up because the government may shut down. But I can tell you that overall, brand new energy came into the market when the Trump administration came in. Whether you're to the left or to the right, we're just discussing that brand new market energy came into the market that sent the market to dramatic new highs. We're talking about the Dow Jones, NASDAQ, S&P, to dramatic new highs. And it's been one of the most remarkable runs we've seen. And I think a great deal of what people like is the fact that this current administration is really more focused on improving the lives of Americans through the economy, through better security, through lower taxes, and not so focused on who's to blame and social justice, because the country can only last so long chasing those down a rabbit hole. The business of the United States and how we got to be such a great country is rooted in our fantastic, nearly supernatural ability to come back and produce new product, new ideas, and push through to new levels. And I'm very happy, and I think a lot of people are very happy to see the United States really turning the ship at this point and apparently getting back on track for better GDP and just better economic conditions overall for everybody, whether you're on the left or the right.
You mentioned earlier or yesterday you talked about gold, and I'm not sure if I remember you mentioned here, but kind of go back to the gold conversation yesterday. You had some comments about it.
Yes, we had forecast on the 16th of this week, which was Tuesday, gold had reached 1345. We told our worldwide trading group that gold would decline down to 1325 to 1324 from 1345. That constitutes a trade. And they would do that into Friday, January 19th, plus or minus a day. So yesterday was January 18th. The swing low in gold yesterday was 1324.30. That certainly constitutes a completion of that forecast. And we will be looking to early next week probably to put a new trade together in gold for our clients. And I don't mind telling you now what that trade is. It's just that we can't take it just yet. We can't put it on yet. But if gold does certain things between today and Monday, we very well may be buying gold for an advance back up to 1340 or higher into the 29th of January. So one of the nice things is that our clients get a very specific date that a very specific price is going to be reached, and we turn that into a trade and we run with it. And I hope that some of your listeners who may be interested in the markets will give us a look and take a look, a free trial. Let us show you what we can do with the markets, how much is possible to be known in advance, and see if it's useful to you in your own investing and trading.
David, I've got a question for you. We had been talking about the bond market for a little bit, had a triple bottom, and then it broke down through it, rallied a little bit up to that resistance area, and now it's falling off again. So a lot of room between where it is, 148.28 and 145.26. That low was back in March. Give me, because this is going to change the dynamic for the dollar and real estate and so on. I mean, do you have any thoughts on the bond market?
I do. We are bearish on the bond market. Our most recent tradable forecast was that if the 17th, which was 2 days ago, if that day closed below 150.12, then the market would be smashed down to new lows previous, below the 149.03 level. And that's exactly what happened. But that's just a short-term trade. What we are more bearish on longer term here is that we think the bond market has more to go on the downside. This means increased interest rates. And, as you said quite correctly, this affects not only the real estate market, but many, many other markets and currencies as well. At the very minimum, we're going to be looking for the 156 level on the downside prior to the ending of this decline. That's 3 full handles lower. But we also have an indication for the market to actually get down as low as 142 and change just within the next couple of months before this decline is over. So if we close the month of January below 149 in the bond market, this is the 30-year U.S. Treasury bond market, we believe that the bonds are going to ultimately end up down not only at 146 but at 142, and that's life-changing.
Yep.
Because that's huge. That's another 6 full handles on the bonds to the downside. That will change interest rates, change real estate. It's going to make a difference.
It seems to me, and I know we're both technicians first and foremost, but you do have to consider the fundamentals. But it seems to me that what we're seeing in the markets is the setup, if not already what's already in place, of a perfect storm. Control of higher rates of inflation, but the good kind of inflation, and control of a stronger dollar, not something that outweighs trade and kind of leaves you with deficits, but it seems to me that everything seems to be, and I don't want to be too over optimistic, but we're getting interest rates moving, so banks make a lot more money in the spread. Dollar is staying stable yet stronger. Inflation is coming, but not out of control, which fuels more prosperity in for the equity market and the general economy as a whole. Is that on a fundamental basis based on what your technicals is? Are you seeing it the same way I am, or
I am. I was just going to say this is why you have your job, because you very adroitly put together what I think is the perfectly accurate picture of where we are right now in the economy, and that inflation, and the good kind, is probably coming back. It's not right around the corner, but we're going to be there during 2018. We're going to see some. That's going to make a big difference. It's positive. And as you know, and all technicians know, the fundamentals often get already blended into the market to then create the technicals that technicians follow. There really is quite a gap often between the news of some impending thing or that impending thing happening and the market's total reaction to that. I'm not a big fan of the theory that the market is too efficient for people to trade because it's a little complicated to go into. But time frames make a difference. If some big news comes out and the market needs to move a great deal to adjust for that, it can often take months for that to occur, and or even weeks or days. And there's time in there for traders to take advantage of that.
Got it. We got to go, Dave.
Okay, great. Thanks for having me on. I look forward to seeing you here on Monday.
You got it. Thanks, David.
Thank you. Bye-bye.
David Williams, Pagetrader.com. We're going to go to a break, and Ray Schroeder on the other side of this break. Wealth Care Center Connect.